Hello and welcome to our conversation. The focus of this conversation is to understand the financial statements of some companies. And today the focus is on Hyundai Motors India Limited, which has actually started its IPO a few days back. The focus here is only to get into the financial statements of Hyundai Motors India Limited. We are not getting into the market structure, the supply and demand for the automobiles in India. The reason why we picked up Hyundai Motors is that Hyundai Motors has opened its initial public offer, and this is one of the largest, or in fact, the largest IPO of 27,870 crores, the details of which we will see as we move along. In 2010, Coal India made an IPO for 15,000 crore. In 2021, Paytm 18,300 crore. And in 2022, LIC made an IPO for 21,000 crore. And now Hyundai Motors is going for 27,870 crore. Hyundai Motors, let us understand what is this company is all about. It was incorporated on May 6th, 1996, and its parent company is Hyundai Motors South Korea, and the Hyundai Motors South Korean parent company was incorporated on December 29, 1967, and that's listed on Korean Stock Exchange. Hyundai Motors owns 100% shares of Hyundai Motors India Limited. HMC, in short, the parent company's name, holds 812 million equity shares of face value of 10, which is entire capital of Indian subsidiary is with the parent company. And of this, about 17.5% stake, the parent company, HMS, is going to divest, and therefore the entire IPO is an offer for sale. So 17.5% comes to about 142 million equity shares of face value of 10. The Hyundai Motor Company, the parent company, is owned by Hyundai Mobis, which holds 21%. National Pension holds about 7%, and the treasury stock have 3.6%, and public shareholding is 67%. So any change in Hyundai Motors is expected to affect the markets of South Korea also. And Hyundai Mobis, Kia Corporation, another South Korean company, holds 17.6% of Hyundai Motors. And interestingly, Hyundai Motors company owns 34% in Kia Corporation. So we can see that there is an interrelationship between the companies, and most of them are South Korean based. So now we can see the entire picture in one slide, that Hyundai Motors is 100% parent company of Hyundai Motors India, and Hyundai Motors has a shareholding by different companies, and the largest shareholding is in the hands of the public. And one of the important shareholders of Hyundai Mobis is Kia Corporation, and Kia Corporation is also the Hyundai Motors South Korea has about 34% in Kia Corporation itself. So we can see the interplay of related parties among these shareholding, among these companies. Now let us see the financial statements, the focus of this presentation. So we picked up the consolidated financial statements from screeners, and wherever required, we fell back on the red herring prospectus document also. For the last 4 years, we can see the capital of the company, the consolidated, is 813 crore. The reserves is 14,449 crores, has reduced to 9,853 crore. We'll get into the details as we move along. And we can observe that there is a marginal fall in the borrowings. However, the other liabilities have increased to some extent. On the other hand, we can observe that the fixed assets of the company are more or less stagnant and the range of 7,000 to 7,500 crores. And interestingly, the capital work in progress, which conveys a message about the creation of fixed asset, has also not increased over a period of time. That means it conveys a message that there is no major investment on the fixed assets creation. And the other assets, one of the important components of the other assets is the cash. And we can see that cash has drastically come down in the last 1 year from 17,700 crores to 9,000 crore. And we'll see some interrelationship between these items of the balance sheet. The capital has been contributed by the parent company over a period of time. At the time of the formation of the company itself, initial capital, and after that, by 1999, the company was started in 1996, and by 1999, in different stages, at different stages, the capital was contributed. In early stages, the capital face value of the capital was 1,000 and issue price was also 1,000. So that means the shares were issued at par. And recently, just before the IPO on May 17, 2024, the company decided to split the shares or reduce the face value of the shares. The authorized share capital of the company, which was 14 million equity shares of face value of 1,000, has been split into, by having the face value reduced to 10 rupees per share. So as a result, 14 million shares have become 1,400 million shares. As a result, the paid up capital has also made a corresponding changes, has increased from 8.12 million to 812.5 million equity shares of rupees 10 per equity share. So at present, the face value of the share is 10, but this change of face value has happened just before the IPO from 1,000 to rupees 10 per share. Now let us observe that two important items on the balance sheet which we observed here: reserves, fall in reserves, and the fall in cash. Observe these two. The reserves have gone down from 19,242 crores to 9,853 crore. And in the same period, cash has gone down from 17,700 crores to 9,000 crore. This reduction in the reserves and the corresponding reduction in the cash is due to a huge amount of distribution of dividend. So the distribution of dividend also happened in the recent past. Now, and they have been distributing dividend consistently, but there was a special dividend in the last year. So to understand the composition of the balance sheet, we can see that over a period of time, Hyundai Motors India has become more and more a liability-driven company, less of equity. Equity has gone down from 57% to 40%, and the liabilities have gone up to 60%. And here we have taken both short-term, current and non-current liabilities together. And equity is capital and reserves. And the fall in equity, as we have seen here, is because of the fall in the reserves. And fall in the reserves is because of the distribution of dividend, which is also visible here. The cash has come down from 51% of the total asset to 34%. And this can also be seen, observe when we see the cash flow statements. Because the change in the cash because of the dividend will be definitely visible in the cash flow statement. The cash flow statement summary shows like this, that the cash from operating activity, because Hyundai Motors is a profit-making company, we can see that consistently the sales has been rising. Both operating profit and the net profit has been consistently rising. The profit has gone up from the operating profit has increased from 4,000 crore to 9,000 crores. And the net profit has also gone up from 1,800 crore to 6,000 crore. This is because of the change in the demand of automobiles all across the industry. And Hyundai has been one of the fastest growing car sellers in India. In 2024, they have sold around 7,20,000 cars in Indian markets and some amount of exports too. So this cash from operating conveys a message that operationally the company is doing well. The cash from financing, there is a big amount of negative cash from financing in the last year, 2024. So the negative cash from financing happens when there is a repayment of capital or reduction of liability or distribution of dividend. And in this case is to a large extent because of the distribution of dividend. We can see that. About 15,000 crores of dividend, special as well as the normal dividend together, has been made in 2024. In the last 3 years, we can see that the company has distributed dividend to the parent company, which is a 100% subsidiary is in the Hyundai Motors India. So the entire money obviously goes to the parent company. So 15,000 crore in 2024, 1,400 crore in 2023, and 1,354 crore in 2022. So a significant part of the cash from financing negative is because of the distribution of dividend. And that is why we saw here that the reserves decrease and a corresponding decrease in cash is due to a big amount of distribution of dividend. In fact, several newspapers carried this article and brought this to the notice of public in general, that Hyundai has been one of the largest dividend distributors in the last year. And in fact, you can see that the dividend per share is the largest among all these companies, 13,270 rupees per share have been distributed as a dividend. And other than Hyundai Motors, there is no other automobile company in the top 10 which has distributed dividend, though most of them are making profits. Now let us see the offer. The money to be received, as we already said, that about 142 million shares are the offer for sale, OFS, which is approximately equal to 7.5% of the total stake of the parent company in the price range of 1865 and 1960 in a book building exercise. So at the highest band, this comes to 27,000 crore, and the lowest band, it's come to 26,519 crore, which accounts for, if I take the highest price band, is a price to earning ratio is around 26.3, which is of course in the range of the other players in the market too. So now let us see the return to the parent, cash return. We've seen there is a cash outflow. Cash transfer to the parent in the last 3 years. The cash is transferred to the parent in any case, in any company parent subsidiary relationship, maybe in the form of dividend, maybe in the form of royalty, maybe in the form of buyback of shares or other forms also. So for the time being, for this presentation, we are not getting into the nitty-gritty of all related party payments. We're only picking up two important items, that is dividend and royalty, which has been explicitly mentioned in the red herring prospectus. The dividend distributed in the last 3 years comes to about 18,288 crore. And the royalty distributed, royalty means the parent company and Indian subsidiary has a royalty contract. Approximately 2.5 to 3% of the top line, the total revenue, will be given as a royalty, quarterly calculated and cash dispersed. So that amounts to about 4,096 crore. So in the last 3 years, about 22,000 crores have been transferred. 22,000 crores have been transferred to the parent company in the form of royalty and dividend. And top of it, if the OFS is successful, if the offer for sale is fully successful, another 27,000 rupees will go. Now, if you observe only capital divestment, total number of shares, the paid up capital is 812.5 million shares, the face value of 10. So 812 crore or 813 crore approximately is the investment of the parent in the form of capital. Of that, about 17.5% will offer for sale at a price band of, if the highest price of 1960, that comes to about 182, 142 crores at the rate of 1960 comes to about 27,870 crores. So the return only on that, the price is about 19,600%, 196 times. So without recognizing the other transfers made. Along with that, the red herring prospectus has also identified, very clearly explained and brought to the notice of the potential shareholders several risk factors which affects directly the financial statements. I'm only picking up those risks which will affect the financial statement. The first is the dependence on the parent. They very clearly say that we depend on the promoter for all the operations, including parts and the materials and research and development. So a big chunk of the acquisition comes from of material comes from the parent company. And this will affect the cash flows as well as the operations of the company. Risks regarding the conflict of interest. As mentioned in the ownership structure, two of their group companies, Kia Corporations and Kia India Private Limited, the prospectus clearly says that in a similar line of business, which may involve conflict of interest and which could adversely impact the business. So the related party transactions, because of this Kia Corporation and the parent, there is a possibility this may affect the fundamentals of Hyundai Motors India Limited. In the same way, they also depend in the Hyundai Motors India depend on the group company Hyundai Mobis company to supply the spare parts for after-sales service. This is again another big related party transactions possible. So the risk factor very clearly says any failure by Mobis to supply these parts will adversely affect. The royalty agreement, which has been already mentioned, clearly affects the bottom line and cash flows. That there is a royalty agreement with the parent company under which they're required to pay an amount equal to 3.5% of the sales revenue. And we saw that the amount of royalty distributed in the last 3 years has been significantly high because the sales is going up. Increase with the royalty payments will increase with the increase in the sales. And the approximate rate of royalty is 2.5 to 2.7%. It's very clearly mentioned that the company has made special dividend to the parent company. So therefore, as the balance sheet itself shows, the reduction in reserves and reduction in cash. The prospectus also says clearly that their ability to utilize the internal accruals and cash to invest in a business has been reduced and have been adversely affected on account of the special dividend aggregating to 10,782 crore paid to the parent. And very clearly mentioned, as a result, we may need to borrow and incur borrowing cost. Because there is an outflow of cash in the form of distribution of dividend, in case of any additional investment required, the company need to borrow. It also conveys a message that the parent company may not invest money in the form of equity in the near future. And quite a significant part of the suppliers are related party. We can see that about 37%, 32, 38 to 39% of the material sourced are the related party. There's nothing wrong in having acquisition of supplies from the related party, but it affects the cash flows. This is all the more important when there is a big divestment of a big cash outflow in the form of a continuous dividend, continuous royalty, and the purchase of material, spare parts from them. I'm not getting into the other risk factors because these are the 7 risk factors which have a direct impact on the balance sheet, income statement, and cash flow statement. So overall, we are able to see that the company as such is doing fine. Financially, the company is doing well because the industry is doing well. But the problem is with respect to the huge amount of cash transfer from the Indian subsidiary to a foreign parent company. Will the money that the parent company collected through OFS, will it invest? We don't know. And RH, the draft, the red herring prospectus was also mentioned that the company may go for borrowing rather than investment. So despite the good operating efficiency, a question may come to mind, should I invest money in this company or not? So invest or not invest, you decide. Thank you very much.